Hey YouTube, what is up? My name is Reese, and today I'll be talking about 5 simple tips that I believe that any new investor should know before they start investing in the stock market. And while video is going to be more geared towards beginner investors, this really applies to anyone, I believe, who is serious about taking control of their finances or someone who's already invested in the stock market. I believe that these things can be really beneficial to know and think about as you are investing. So to start off, I believe that you should only invest in money that you can live without. Now, what do I mean by that? Obviously, when we are investing in the stock market, we don't want to lose that money. The goal of investing is to grow your money, not lose it. But the key takeaway from this is really, let's say you're saving for a house down payment or a new car, or something that's going to incur a pretty decent chunk of change. Investing in the stock market is really not the best way to do that in the short run, because in the short term, no one really knows what's going to happen to the stock market. The stock market tends to fluctuate quite a bit, and it would suck if you had invested in the stock market and then you're trying to buy a house down payment with that money, but then you lose 50%. And I believe that there's less riskier assets that you can purchase, such as just putting your money in a high yield savings, a CD, or a bond. And that can be better for money that you need or will be using in the near future. On the other hand, if you're investing for 10 plus or years time horizon, investing in the stock market can be a great way to generate positive return, because historically, over long periods of time, the S&P 500, for example, has always increased. There's periods of downturns and recessions, but in the end, the S&P 500 has always increased historically. Next is try to avoid chasing returns. And what I mean by that is as of right now, there have been a lot of talk about growth stocks performing really well, and there's a lot of the top and heavily invested index funds currently are growth funds such as VUG or QQQ, VUG, and the NASDAQ 100. And a lot of these growth stocks, it helps to take a step back and think about why a certain index has been performing so well for the past few years or so. And I really believe that the past decade that we've seen this bull market specifically mainly been driven by tech companies is due to a period of sustained low interest rates. And that has allowed these growth companies to gain access to cheap capital and use that to fund the growth of their company. And historically, there have been periods where certain sectors have outperformed another, but in the end, what overperforms today is likely to underperform in the future, because sectors will rotate in and out of favor. Think about energy stocks, for example. They have periods where they can do very well in periods of high energy prices, but tend to get oversold like crazy whenever there's a drop in oil prices. And even as of right now, energy companies are the best performing sector of the S&P 500 year to date, whereas tech companies are among the most oversold. And while that is a short-term comparison, it shows that there's periods where value can overperform growth. So what I'm trying to get at is, when you're looking at the returns of a company or an index fund, try to take a step back and know why it's been performing that way, and do you really think that will hold in the future? Next up is try to keep your portfolio simple. And I've seen a lot of portfolio recommendations and suggestions online where I've been doing my research of people who have kind of just buying anything and everything, because in the hopes of diversifying, they're really overcomplicating their portfolio. And as Warren Buffett's even said himself, is one of the best ways that he recommends the average investor to invest is just buying simple index funds like an S&P 500 index fund. And what that does is it has built-in diversification. You don't have to worry about following individual stocks or companies and having to worry about a company moving out of favor and potentially being less competitive than its peers, and suddenly you're holding a company that's underperforming everything else. And so by investing in an index fund that's diversified across different companies or sectors, you're kind of just owning it all, and you're getting the benefits of growth companies in a bull market, and then you're getting also the benefits of value stocks when they have their time to shine as well. So I really believe that trying to keep your portfolio simple with a few good key holdings such as total market S&P 500 fund as a core holding, and then you can allocate smaller amounts towards individual stocks if you believe that you do have that time, or index funds that might pay them are targeted more towards like dividends or value or growth, whatever you believe fits your investment goals. But trying to keep it simple is your best way to kind of just make things easier for yourself, so you're not worrying about investing time and energy trying to keep up with your portfolio. You can just let it sit and do the work for you. Next is try to have a plan and stick with it. Now, what I mean by that is I've seen a lot of things of instances where people will buy one thing with a certain idea in their mind, and then 3 months later they completely reverse and they're like, oh, instead of doing that, I want to do this. And so they're kind of just moving their money around constantly. And I really think that when you're buying a certain security, whether it's an individual stock or an index fund, know going into it why you are purchasing it and have a goal in mind. If you are going in blind and just kind of buying something because you hear it might be a good buy, for example, that's really not having a plan. You're kind of just blindly entering something because that's what everyone else is doing. And that could be argued to be herd mentality can single-handedly move companies up if everyone wants to buy a stock. We've seen that with like GameStop with that pump, for example, where everyone was like, let's buy it. And that goal there was to create a short squeeze. And it did work successfully for those who sold at the peak. But if you've been holding it and you bought in at a high, that's really not a good idea. And so what I'm getting at is try to take a step back with any investment decision you have and have a plan, educate yourself going into it, and know what you're trying to get out of that decision. So for me, I'm doing auto investments in a Robinhood account and a Roth IRA account with TD Ameritrade, for example, where I am simply just auto investing funds into a diversified index funds and a few key holdings, and just letting that ride out the market. My time horizon for those portfolios are 20 years or more. And so I'm willing to ride out downturns or bull markets, whatever it is, whatever happens to the market will happen. My plan with those portfolios is just to dollar cost average and just let the power of compound interest do its thing. And now everyone's circumstances will be different. Some people's plans will work better than others, depending on what suits their individual needs. And then that ties in with number 5 is starting early. Time is not your friend, and the power of compound interesting is truly remarkable. And the power of compound interest is simply that over time, your money will start to grow exponentially as the compound interest starts to work and do its thing. And there's a really cool calculator that you can use online. It's a simple compound interest calculator that I'll include in the description. And basically, you can play around with time and interest rates, how much you're willing to invest, and starting principal. And you can use that to kind of play around and see what affects what in the long run. And you will find that the biggest factor is that you can invest less for a longer period of time and get higher returns than investing more for shorter periods of time. And as Warren Buffett has said himself, it's the best time to invest is yesterday. The second best time is to start now. And I believe that as well, because even when I'm doing my own personal research and seeing talking with people I know or seeing online, a lot of people think that retirement is just eons away and that they can start saving whether they have more money or in the future when they're in, say, 30 or in their 40s. As you're getting closer to in retirement age, you're losing that power of compound growth in regards to that time horizon. So it's good to start early, even if you can only contribute $100, $50, whatever it is. Just contribute what you can, as long as you're meeting your needs financially. So start small if you have to, and let that sit in the market for whatever time horizon you have, and you can do your best to try to take advantage of the power of compound interest in the long run. And so I hope you guys found this helpful. Now, this video was, like I said, geared more towards people who are trying to get started, but I believe that these rules still, not necessarily rules, but guidance tips can really apply to anyone who is interested in investing or the stock market. And so I hope you guys found it helpful. Thank you guys for watching. I really appreciate the support. Please leave a like and comment below if you have any feedback or comment suggestions. Thank you guys for watching. Hope you guys have a great day. Thank you.